right, this is the big one. It's the non-farm payroll event. So let's get ready for it. Now, payroll data is super important right now because remember the Fed's twin mandate. They want to see stable prices on one hand and maximum employment on the other. They can focus on stable prices if the labor market is okay. So, recap, 200 plus thousand. 3.9% or lower here, 4.3% or higher, 4.2% will do. We'd expect S&P 500 selling. We'd expect euro dollar selling, and we'd expect dollar yen buying, right? Because you expect yields to go up, and what you'd expect is that markets would say, oh, okay, right, we think the Fed is going to be holding higher for longer, right? So we can see this start to flip up. At the moment, sterling markets see 3 interest rate cuts for the Fed. But if the labor market is still strong, they might start pricing in for just 2. And remember, these forecast distributions, right? A surprise, we would need 150,000 or lower. We'll need, and remember the whisper number is 120,000. So this has got to be 150,000 or lower for a surprise to the downside. It's got to be, right? After that weak ADP as well. And with the unemployment rate, we need to see that at 4.2% or higher. Because look, 26 forecasters say 4.1%. That's chunky. So 4.1% is not a surprise. 4.2, yes, it is. And then average weekly earnings. What do we need to see? 4% will do. If it's 4% or lower, that's good because there's only 3 forecasters expecting that. So that would be acceptable. So here's the other scenario. If we see weak jobs, 150,000 or lower here. If we see the unemployment rate 4.2% or higher, and if we see the average year-on-year earnings, if we see that coming in 4% or lower, then expect immediate euro dollar buying. Okay? And dollar yen selling. Now, simultaneously, we also have Canadian labor data. So if we see, and the Bank of Canada meeting next week, expected to cut 70% chance, 71% chance that they're going to cut next week. So what we want to see here is something that pushes back against that, right? So if we see, right, very weak CAD jobs, that's minus 16,000 or higher, priors unrevised or revised lower. We want to see the employment rate, right, coming in high, 6.8%. So this is minus 16, and that's 6.8. That would be weak jobs. And then we've got to be conscious of what's going on with the NFP. They're released at the same time. So if we see Canadian jobs weak and the US jobs weak, right, look for Euro CAD upside. So if it's a miss here, if it's weak US, weak Canada, that's Euro CAD upside. And then if it's CAD jobs are weak and US jobs are strong, it's dollar CAD upside. If CAD jobs are strong and US jobs are weak, it's Aussie CAD downside. If it's CAD jobs strong and US jobs strong, it's CAD yen upside. Let's make sense of the data. Here we go.
So look out for the US jobs report. Mixed. Ignore 151. That's 151 below the expected 160. Unemployment rate 4.1%, above the expected of 4%. Then for the revision, that's priced lower to 125. No, earnings month to month in line at 0.3.
Unemployment rate. We want to see it 4.1% will do. And if we see average earnings year on year, that's 4% or lower. So it is appropriate to go euro dollar upside. That is appropriate. Okay, euro dollar upside is appropriate. That should be dollar weakness. Let's just see how that's reacting. Yeah, you would expect euro dollar upside. And you would expect a little bit of upside in the mini, which is happening at the moment, right? But that is acceptable. Okay, euro dollar upside. Let's just see. Because is that a weak print? And the answer is yes. Look, headline 150. Unemployment, ideally you want to see that 4.2%, but that will do, right? And then we want to see earnings 4%. And that and the prior downward revisions, that just gives you a little bit extra, right? And you're asking for upside in the E-mini on that. Should see some upside in the euro dollar on that. That's not unreasonable. Let's have a look. It is, I would, stops could be placed just underneath that R1 pivot, right? It should not break lower than that. And then I'm looking for the R2, you see. That's not unreasonable because that should weaken the dollar a bit further. Yeah, it's not a very strong reaction. I would have thought we'd get more of a reaction on that. S&P 500 trying to bottom, which makes sense. That should be weak because look, 151,000. The whisper number was 120, but that's still with the downward revision, that's a weakening. Unemployment rate 4.1%, right? So that is towards the high end. And you've got the average earnings at 4%. So yes, we missed on that one. We wanted that 4.2%. So that's really what's going on here. Let's see how that dollar's doing now. That's better. It's starting to take off again. Stop in the E-mini should be underneath the 5735. So it should be underneath the pre-release price. 100%, right? Right. Euro dollar's finally taking off. Surprisingly slow, really, considering the print we got. The euro dollar. Well, I think the euro dollar, I would expect a little bit more legs from it. That's your first area to potentially take profit. So that the first target is kind of hit, and you have to see from here, really. Let's look at the short-term interest rate markets to see what's going on there. See if we've got that updated. A massive change. Okay. Yeah, I mean the problem with the euro dollar, and Sergey pointed that out, is if you look how much dollar weakness we've had, it's just been dollar weakness, dollar weakness, dollar weakness, very heavily sold, you see. And that heavy selling, right, just leads markets to getting like exhausted on the dollar, right? But it should be fine. We've kind of hit that R2 and just bounce straight off it. So euro dollar trying to pick up again, but it could literally just be chopping about a lot today. Yeah, okay, looking at that. It's popping up a little bit. I think I wouldn't want to see this come back against me, this euro dollar. You just want to see that hold there. I think the thing to do here is, I think if you haven't got out on that euro dollar, I wouldn't let that hang around. We've kind of got the one opportunity. So if you start going back under these lows, I'd scrap it. Doesn't really make sense to carry that on if you didn't take off at the pivot point. All right, folks, so depending on where you got in, I'd be at break even or underneath those lows. Apart from that, I'd leave it, if just be sensitive of a reversal, because a weak labor market can mean trouble ahead for the US. So just keep that in mind.